What's up, everyone? It's Scotty with MoneyVest. So I've got a US market update and an economy update for all of you. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel as well. In this video, we are going to be talking about the recent comments from Professor Damodaran on the tech stocks and the current valuation. And more specifically, there was a research report going over the inversion of the yield curve, which we have talked about several times on our channel in the past. And of course, there's been a lot of research. There's been a lot of concerns over that inversion of the yield curve and whether that's going to actually lead to a potential recession in the US or not. And right now, the narrative is very much focused towards a soft landing where inflation's coming down and everyone's kind of excited about, the Federal Reserve pausing interest rates and not really, raising rates anymore, and then potentially cutting rates in 2024 so we can actually get a soft landing. So it's going to be data driven. So we're going to talk a little bit about the average lag periods. We're going to talk about the number of times the inversion has happened in the last 72 years, 75 years, going back as far as 1950s, and how many times post-inversion rally, which is what we are seeing right now. This is really the rally that we're witnessing in 2023, is a post-inversion rally, meaning the yield curve has inverted and we are rallying after that's happened, how many times that has lasted and how many times it's rolled over. So all that is going to be covered in this video. As always, make sure that you drop a like and subscribe to the channel. So this right here is going to be the recent comments from Professor Damodaran at NYU. He says tech stocks are likely overvalued and will run out of steam by the year end. So he basically mentioned that tech giants, including Apple, Microsoft, Alphabet, have seen such large gains so far in 2023, and shares are potentially in the middle of a, quote, boom and bust period. On a pricing basis, when you've seen as much of a run-up as you've had, you are more likely to be overvalued than undervalued. And he says you don't get a 40% run-up on companies of this size without expecting some degree of overvaluation. He says that wasn't always the case. As recently as January, some of the biggest players in the tech sector were skewed to an undervaluation. So at the beginning of this year, we were most certainly trading at very, very low multiples. And as the year end approaches, the trend could shift, he said, even if investor sentiment remains strong more broadly. He says, and I quote, "I think that if the market is going to be tearing for the rest of the year, I don't think these companies can do it." And, what he's really talking about is, look, we've already added hundreds of billions of dollars, if not trillions of dollars in market cap for these companies. Where is that additional liquidity is going to come from, right? If these stocks can really start to go up even higher, right? If there is any potential for a rally for individual stocks for tech sector, where is that additional liquidity going to come from, right? If Apple needs to go up another 25%, it needs to add a full 25%, so 3 times 0.025, we're looking at $750 billion, right? If Apple goes up 30% from these levels, it would need to add close to $1 trillion in market cap. Same is true with NVIDIA, right? If NVIDIA wants to go up, let's say another 20% or 30%, it would need to add close to $300 billion, right? That's a lot of money. And there's not enough liquidity going around for us to see those types of gains from these companies. So yes, multiples have expanded to a degree where they are now starting to trade at pretty expensive valuations, so not to mention that they are quote-unquote overvalued according to Professor Damodaran. But then also, if the investor sentiment continues to be very strong more broadly, moving forward in the fourth quarter, there is a possibility that there is sectors that are underperformed, other sectors in the market that actually end up doing better compared to technology stocks that have already rallied 30, 40, 50%. So, and again, I do disagree with it a little bit there because we have seen a bit of a pullback in August. We are seeing some seasonality September seasonality, which is pulling back on a lot of these stocks. So I do expect Q4 to be very strong. So I do kind of differ with my analysis with Professor Damodaran here, kind of suggesting that in the fourth quarter, especially November, December, I do expect some more momentum and a little bit of a rally for a lot of these individual tech stocks for us to close the year very strong. But of course, 2024, we'll find out, what happens with the economy and the market. Now, speaking of the economy, this right here is the yield curve. And the yield curve is basically taking into account the spread between a long duration bond and a short duration bond. The most widely watched yield curve is the 10-year versus the 2-year. And if that spread is negative, that means we have an inverted yield curve, right? Because it doesn't really make sense for a short duration bond to be yielding a higher rate of return than a long duration bond, right? That's a bizarre scenario. in the bond market. And when that happens, well, there is possibility for a recession. Not only a possibility, it is almost a guarantee that there is going to be a recession, because since 1953, the inversion of the yield curve has happened 12 times. So you can go back and see and count for yourself. So it's happened 12 times, and every single time it's been preceded by a following recession, right? There's been a recession after the yield curve inversion took place. So the gray areas you guys see are going to be the recessions in those time periods. And this is where we are right now, -1 to 2%. And just to clarify, this is not the 10-year versus the 2-year, but this is 10-year versus the 1-year. So the author or the research report this was posted is taking into account the 10-year versus the 1-year. And I'm sure the stats are going to be very similar if you were to take into account the 10-year versus the 2-year. So, importantly, during these occasions, the inversions was shown to have preceded the eventual recession by a wide range of between 7 and 25 months with an average lag of 14 months. Okay, so what does that mean? That simply means that every time there was an inversion of the yield curve, the average lag time was for a recession was 14 months. And the range was between 7 months and 25 months. Think about that for a second. 25 months, 2 full years after the inversion of the yield curve is when we actually experienced a recession. So that's how long it goes up to. And of course, the average lag time is 14 months. So we're not quite out of this average lag time period yet, because if you go back and you basically understand that we are currently 13 months into this inversion, and it is woefully premature to assume that the yield curve has given a false signal, and this can be labeled as a soft landing, which is already in the bag, is what the author mentioned. And a look back through the financial news pages shows that soft landing, in fact, soft landing stories were very common, and the yield curve signal was dismissed going into 1990, 1991, 2001, 2007, 2009, and 2020 recessions. What the author is really saying here is that in these time periods, the soft landing story gained a lot of traction every single time. And of course, we are 13 months in to this cycle, and the average lag is 14 months for a recession after the inversion of the yield curve. What's even more concerning, and again, this is not really concerning to a point where we have to start panicking, but instead it is a point where we can prepare. And of course, if there is deals out in the market, then we can start taking advantage of it, right? So it's basically a way for us to prepare, have some dry powder ready, have a lot of cash ready for when there is maybe a pullback or a sell-off or correction or whatever. We are ready to dollar cost average and scoop up a lot of these deals for our favorite stocks. And of course, if tech can continue to come down and come down to more fairly traded, fair multiples, even undervalued levels, we are able to take advantage of it. So they basically mentioned that the research shows that nearly 7 decades, there has never been, I repeat, there has never been in the last 7 decades a post-inversion equity rally that was not completely reversed going into a subsequent recession and a bear market. So what they're trying to say in this sort of line here is that there was never a time in the last 72 years, in the 7 decades that they've analyzed, that a post-inversion equity rally did not reverse going into that subsequent recession, right? It almost always did. And this is the chart that they basically go over. So in nearly 7 decades, there has never been a post-inversion equity market rally using the 10s and the 1s treasury spread that has not been more than fully reversed going into a subsequent downturn or a bear market. So the bottom line here, and the lesson to basically take away, is we've got a few more months. In fact, I would say we've got 11 months, 11 to 12 months, maybe one more year. So when I'm doing another video, say September of 2024, if by then there is no recession in the US and the economy is able to skirt through a recession, avoid a recession, and inflation's back down, we are in the clear, okay? And that will eventually lead to a soft landing. But until then, there is a possibility. There is a possibility that the unemployment starts to break apart, and that's really what's going to kickstart that potential fears around a recession. Because I know there is a narrative right now which is very popular around a soft landing, that inflation is going to come down, the labor market's going to be tight, interest rates are going to get cut, everyone's going to be happy, and there is going to be this ongoing bull market, which is going to continue. So not even recent action is unprecedented. US stocks rallied more than 20% when the yield curve inverted in July of 2022 to July of this year. So it's been 12 months. But such bounces have happened before, the author mentioned. And on average, equity markets bottomed about 20% below where they were when the curve first went into inversion. And the range of outcomes would be consistent with the S&P 500 having more than 20% downside from the recent market highs. And in short, those who are doubling down on the soft landing ongoing bull market call now are making a wager on an unprecedented occurrence, meaning on an occurrence that's never happened before, right? We've never gone through a period where a recession did not follow a yield curve inversion in the last 7 decades. Every time a recession has followed when the yield curve inverted. Every time unemployment went up when rates went up, something that I did mention in my previous videos, but this time could be different, right? And those are the 4 most dangerous words in the market and the economy. This time is different. 4 most dangerous words in the market. So always remember that. And again, this is not, I know that there's going to be some comments that these videos are bearish or these videos are creating a lot of FUD. No, we're going over data. Like if you want to fight and argue numbers, I can't talk logic with you. Numbers are right there. I'm only going over the data points, which is to say that every time the yield curve has inverted, the 10-year versus the 1-year, when that spread has turned negative, we've seen a recession in the last 12 out of 12 times. There's never been a false signal with an average lag of 14 months and the range of 7 to as much as 25 months. So to say that we are in a different time, that we're going to avoid a recession, could be premature. And a post-inversion equity rally has almost always, not almost, always given back on all those gains preceding a subsequent recession and a bear market. So some things to keep in mind, again, right? So very important stuff. Hope you guys enjoyed it, found it helpful. Make sure that you drop a like. Let me know your thoughts down in the comment section below. And what do you think about this? And how are you preparing? And like I said, these are going to only represent opportunities. This is only going to create a lot of opportunities for us to dollar cost average into stocks and get good deals in the markets once again for when they are trading at undervalued levels. So that's really the whole point, right? To be investing long-term and finding deals in the market. So as always, happy investing. Let me know in the comment section down below. What do you think? Links to our Discord, Patreons down below. I'll see you guys in the next video.